This time it is not different from the standpoint of how the cycle usually plays out, meaning inversion first, uninversion, Fed drops rates, stuff hits the fan. Now, how long that takes to play out, I don't know. My base case is that that's what we'll see play out again. If we're going to use the thought experiment of the government not doing anything, if the government doesn't do anything, and I think even if the Fed wants to come out and buy, do QE, I don't think that's really going to do anything either. And when they drop rates, again, they don't drop rates to fix something. They drop rates in response to something that's already happened. Now, maybe if they came out and started buying stocks, like the BOJ, that may change my mind. But let's just assume for a moment that the Fed just comes out with their standard, okay, we're going to start doing QE again. And the government doesn't do anything in the form of fiscal or bailouts. Then I completely agree with Jim Rogers. Again, no certainties here, only probabilities. And by the way, I just spoke with my good buddy Patrick Ceresna from Macro Voices in the Market Huddle. And his base case is the dot-com bust as far as that recession. And he made a very good argument as to why what we're seeing play out right now with all the markets is maybe not exactly, but it definitely rhymes with the dot-com bust, where we just had kind of like a garden variety recession. So that's definitely on the table, but it probably wouldn't be my base case. My base case would be we see probably like a GFC type of thing, and but maybe even more deflationary if the central planners stepped back and didn't do anything. But if or maybe when is probably better said, when the central planners do respond to it, because I fully expect that they will, you would probably see, I'd probably just assume it's more of the same. Meaning that when we get the dot-com bust, okay, they respond to that with just interest rate drops. Okay, fine. Then we get the GFC and they respond to that by dropping interest rates and doing QE and doing all these bailouts. So my point there is you'll notice each time we have a crisis, they do more and more and more. They take more and more of the medicine and they get diminishing returns. And then we fast forward to COVID, and then it's like it made the GFC or the response to the GFC look like child's play. We came out with trillions and trillions. I don't know what the CARES Act was, like 4 or 5 trillion, something like that. And so I would expect that they'd probably do the same, that instead of a CARES Act, we do like a CARES Act 2.0, and instead of 4 trillion, it's like 8 trillion or something like that. And so assuming they do that, I would expect, I don't want to call it a V-shaped recovery because that implies that growth goes back to trend, and I don't think it will. I think that growth will kind of notch down and that will be a new trend line. But I do think we'll see a repeat of the wealth gap getting much bigger, where it's going to benefit people with assets because the central planners realize that to keep this game of Jenga going, they've got to prop up asset prices. Even if it creates all the homeless that we've seen, even if it creates the drug problem, even if it lowers the standard of living, even if it decreases the purchasing power for the average Joe and Jane, they realize that if the stock market goes down by 50% this time, it's going to be a much, much different story than 2008, 2009, because the U.S. economy is so much more dependent now on asset prices than it was even back then. I live in Medellin, Colombia. That's true. And I always use this as a thought experiment to take it to an extreme. If the stock market went down here by 50%, no one would even know. And I literally don't even think it would make the daily news, because no one owns stocks. No one even cares about it. It's not even really a thing. So, but the stock market goes down by 50% in one day in the United States, and you're going to have not just a US meltdown, but you'd probably have a global meltdown. And that just shows you the fragility, I think. And the central planners know that. So I think that'll be their focus. And unfortunately, look at the difference that we have seen in society and the standard of living just since 2019. I mean, you guys might not see it a lot because you're I don't know if you're in the US, but if you are, it's kind of like looking at yourself in the mirror every day, where you really don't notice these changes. But nowadays, I only go back to the United States when I have to speak at a conference or something like that. So it might be, let's just say 4 times a year. And even in those 4 times a year, I notice huge changes every single time I go back. And when you compare it to 2019, I think it's night and day difference. I mean, it's just people are walking around like zombies, and you have the homeless problem and all these drugs. And it's obvious that, especially for the average Joe and Jane, their purchasing power has gone down significantly, even though their nominal wages have gone up because they haven't kept up with the rate of consumer price inflation. And when they finally get a break on that inflation, well, what happens? The unemployment goes up, the unemployment rate, and aggregate demand goes down, because the only reason prices are going down is because the economy is in contraction. So you get this cycle where the price is always paid, unfortunately, by the poor and middle class. So I would expect that to continue. But we have to realize that what you're seeing there is not just random. It's not just a result of, people are idiots, so they're doing drugs now. This is a result of government creating economic distortions. That's how this plays out. And so, the response, or the quote unquote solution to any problem we ever have, is more government intervention, more government, bigger government. And what that does is that increases the amount of government spending as a percentage of GDP. And if government spending goes from 50 to 60 to 70, all the way up to, let's just take it to an extreme, 100%, well, you would expect the economy to be far, far less efficient. And if the economy is far less efficient, then we're producing fewer goods and services, and that is going to decrease the standard of living. It's just, there's no way to get around it, unfortunately, other than to do the opposite, which is less government and and get the government out of the equation and bring back free market capitalism. But in doing so, you also have to bring back bankruptcy. You have to let people fail. And that's just what we as a society, or the politicians and authoritarians, refuse to do. Going back to kind of the mechanics behind how the dollar system is created, and why the probability of the dollar crashing is very low, and therefore it decreases also the probability of the dollar losing reserve currency status anytime soon. It also brings you to the sobering conclusion that there is no panacea. There's no panacea. The only way that we can improve things is if we convince people that it is in their best interest to vote and to try to promote smaller government. And like we said earlier, that involves taking a little bit of pain. Other than just a complete and outright collapse. That could be, I hate to go there, but that if you look at the fourth turning as an example, I remember I interviewed Neil Howe, this was maybe a couple years ago, and I was really trying to press him on what the probability is, how the fourth turnings usually play out. And, as he's been saying that we're right at the tail end of this fourth turning. We likely see it conclude at the end of the 2020s going into the 2030s. And I kept trying to find like the glass half full, or the light at the end of the tunnel. He kind of got snappy with me, and he's like, George, look, you don't understand. Every single time in the past, this has ended in war. That's the bottom line. And have a plan B, because there are some bright spots in the world today. Look at Argentina. They're kind of been down in the dumps for quite a while. And obviously the standard of living in Argentina is not what the United States is, but they're on the right trajectory. They're going in the right direction. Who knows how long it'll last? I don't know. But I was just there a couple months ago, and it's a fantastic country. Beautiful. People speak English. I think from a cultural standpoint, and just the way it looks, many Americans would not have an issue being there for a long period of time, because it just kind of fits right in with what they're used to seeing, especially the middle of Argentina. It looks just like the Midwest. It's almost identical. And a lot of people speak English. But my point there is, see what you can do. Don't bury your head in the sand like an ostrich. I always say that's a very poor investment strategy. This is nothing to lose sleep over. Nothing to lose sleep over. It's just something to be aware of and to prepare for. So if in case things get a little worse, then you've got that plan, and you might even be able to take advantage of opportunities that are created by a recession. And when we talk about things sliding down, with the exception of war, when we talk about things going into a recession, it doesn't mean that we're just, like Rickard says, it doesn't mean that we're living in caves eating canned goods. It just means that we have a difficult period of time ahead, just like the GFC was very difficult. Although we had a rebound in the stock market, I remember the housing market didn't bottom out until 2012. I remember that vividly, because that's when I retired and started buying houses. And I remember back then, I would put up an ad in Craigslist for just basic workers, tile guys, electricians, plumbers and whatnot, handymen, to help me remodel all of these houses that I was buying back then. I remember the very first ad I placed, it was like for $12 an hour, something like that. Okay. But this was 2012. And within an hour, I had probably 150 resumes. 150 resumes. Now, I went back. I didn't start selling my rental properties until 2018. So I went back in 2016 and I had to, do some touch-up work on some of the properties. So I placed the exact same ad, word for word. The only thing I did is I just ratcheted it up, it was maybe $15 an hour or something that was appropriate back in 2016. And I sat there, I ran the ad, and I waited, and I waited, and I waited. And after about 3 days, I might have had 1 or 2 resumes. So that's what I'm talking about. I'm not talking about living in caves eating canned goods. I'm talking about 2012, which sucks for a lot of people, but it's not the end of the world. And just like real estate was an opportunity back then, we will see probably just as good, if not better, opportunities in moving into 2025 or 2026, assuming that yield curve is correct again. I'm sure you say this all the time, but not investing in advice. This is just what I'm doing with my own personal portfolio. And I've got a service with Lynn Alden and Chris McIntosh called Rebel Capitals Pro. So I've got a couple model portfolios in there. So the main model portfolio, what I've done is I set this up about, call it 6 months ago, something like that. And I always start with gold, always. So regardless of what my strategy is for the specific portfolio, I start with gold. That's my insurance policy. And so I do 10% gold. And then my second priority is just make sure I don't lose money. And that should be priority number 1, 2, and 3. For some people that might not work. They might want to take a little more risk. It's just my personal preference. So what I did is I went out and I bought T-bills, 1-year T-bills. And then what I did is I took the interest that I was going to be paid when these T-bills mature, and I bought call options. And that's what gives the portfolio a bit of juice while I'm waiting for things to get cheap, such as commodity prices. I know we haven't talked about that, but I'm a firm believer that we are in the process or in the beginning innings of a long-term commodity super cycle. And these commodity super cycles, like everything else, the prices never go up in a straight line. It's always kind of a roller coaster ride, just like inflation is as well, always a roller coaster ride. So we could be in a downturn here for the next 6 months. It probably likely see lower prices if we have a recession, but I think that's really going to be your opportunity to hold on to maybe some of these producers that are paying a great dividend over the long term. So I want to have all this liquidity. That's going back to the T-bills there. But I want to have some upside above and beyond just your 5% interest rate in the interim while you're waiting for this curve to play out. So what I did back in April is I bought call options on the NASDAQ because I was under the belief that, while the curve is still inverted and while bad news was still good news at the time, that you would probably have a blow off top or you would have, something hit the fan. It's kind of like a binary outcome. And I thought flat was kind of, the probability wasn't too high. So I bought call options on the NASDAQ back in April. And when that started working well, I doubled down. But when we got that soft CPI report, that completely invalidated my thesis, because that's when I think that bad news became bad news. Yes, right. And so I immediately sold. But what I've done more recently is I bought calls on the TLT with that money. But to be clear, I sold half the position, and I sold half the position because the liquidity, I'm still by no means an expert. I want to make that clear. I'm just an amateur, probably more of an amateur than a lot of your listeners and viewers. But I didn't realize that the call options I bought were very illiquid because I was going about a year out and I was going way out of the money to get as much pop as I could. And so I'm like, nah, I don't like the lack of liquidity here at all. So I went ahead and sold half the position on Monday. The other half, I'll keep it just to see how it plays out. But what I'm doing now is I'm waiting for the Fed to drop rates the first time. And when they do, I'll probably allocate that capital to more options to try to take advantage of the way the cycle has played out in the past. And that's usually once the Fed drops, to state this again, that's when we see the biggest decline in the stock market and the biggest decline in yields.